The purpose of this video is to illustrate how you can handle multiple choice questions on the analysis of financial statements. Remember that whenever you're doing multiple choice questions, it's quite important to try and come to your own answer before you look at the options given. In this way, you are more likely to come to the correct answer rather than just choosing one of those that looks to be correct. To start with, we'll look at the Cambridge Specimen Paper 1, particularly question 14. A business sells goods at a uniform gross profit margin of 30%. The following information is available. Remember that the gross profit margin means that the gross profit as a percentage of sales is 30%. In other words, your cost of sales must be the other 70%. You are given the revenue, opening inventory and purchases, and you are asked what the closing inventory would be. You need to do this as a two-step process. Firstly, you need to calculate from the gross profit margin of 30% and the revenue of 62,000 what your cost of sales would be. You can then work backwards to calculate the closing inventory. So to calculate the cost of sales, you'll use the revenue of 62,000 times 70%. Remember I said the gross profit is 30% of sales, so therefore cost of sales must be 70% of sales. And we can then work out the cost of sales as 43,400. We know that to calculate cost of sales using your opening, closing, and inventory figures or purchases figures, you would say opening stock, in this case 10,000, plus 45,000 for your purchases, minus whatever the closing inventory would be to get to that 43,400. You can see that I've laid this out as an algebraic equation. You can just make your closing inventory X and then solve for X to discover your closing inventory as 11,600. You then look for which option this is and you would write B as your answer. Number 20. Which ratio measures a business's average credit period? Well, firstly, you want to think about what do we mean. The credit period is the time that you've given your customers to pay back the debts that they owe you. In other words, you are looking for your debtor's collection period or receivables collection period, otherwise known as your trade receivables turnover. If you look at the options here, you can see that you will choose D. Number 21. A company has the following year-end information. You are given the credit purchases, credit sales, total purchases, total sales, trade payables, and trade receivables. In fact, you're given quite a bit more than what you actually need. Before you tie yourself up in knots trying to do something with that, let's go see what you need to work out. The question asks, how long does the company take to pay its trade suppliers? Rounded to the nearest day, because you don't really want to refer to the period as 357 days. That would just be ridiculous. So usually what you would do is you would just round it up to find out how many days it will take for you to pay your suppliers. Remember that the calculation to pay your trade suppliers is going to be your payables payment period or payables turnover. In other words, what are your trade payables, and divide this by your credit purchases, because you want to relate it to what the figure that was relating to your creditors or your payables. So we don't want our total purchases because that includes cash purchases. And obviously if we bought on credit, cash purchases doesn't relate. We are only looking at the credit purchases. And then we will times it by 365 in this case, because we're assuming that these figures are given for the whole financial year. It tells us that this is year-end information. So the period that we are looking at is 1 full year, and we want it rounded to the nearest day. Because there are 365 days in the year, we will therefore times it by 365. So we go and we look for our trade payables, and you can see it's here. Trade payables is 40, and then we look for our credit purchases, and we can see their credit purchases is 320. Everything else you can ignore. So 40 divided by 320 times the 365 days gives you an answer 45,6 odd, and you then round that up to 46 days. You look at the options available to you, and B will be selected as your answer. The next question is number 22. A company wishes to improve its current ratio and its liquid or asset test ratio. Remember that the current ratio is looking at current assets to current liabilities, and your asset test or liquid ratio is the same, it just excludes the stock. How can this be done? Well, what you need to do is you need to keep in mind that you're wanting to improve your current assets or decrease your current liabilities. However, you've got to be very careful that whatever action you take isn't going to just increase both of them at the same time, because that won't actually improve your ratio. So let's look at each one. Increasing discounts to trade receivables. Although discounts will hopefully encourage your customers to pay you sooner, once you've converted your debtors into cash or your receivables into cash, in actual fact your current assets will have reduced slightly because you'll have less cash than the receivables, and in addition you actually are just converting one current asset to another, so you're certainly not actually improving the situation. If anything, you're worsening it. B, increasing the provision for doubtful debts. What will happen here is that if you increase your provision, remember the provision for doubtful debts actually decreases your net receivables and therefore decreases your net current assets. And so therefore, this is not going to help your situation. C, purchasing additional inventory on credit. This would only help your current ratio, not your liquid or asset test ratio, because remember the asset test ratio excludes your inventory. So this would only help your current assets. However, keep in mind that apart from increasing the current assets, it will also increase the current liabilities because we suggested buying it on credit. So that also is not actually going to solve the problem. So there's only one option left, and let's hope that this would help, but let's look at why. Our non-current assets are not part of working capital. So although our non-current assets are going to decrease if we sell them, that's okay. Our cash will increase and our current assets will increase without our current liabilities increasing. And so therefore, this is an option that we can choose. Cambridge, March 2016, paper 1-2, question 19. What is measured by the return on capital employed ratio? Remember that capital employed refers to both own and borrowed capital, and as such, the return needs to be the return that is earned by both the owners as well as the return earned by the people lending money to the business. As such, you would want to use any profit of the business before the finance costs. If we look at all the options that are available, that would lead us to choose D, the return earned on funds invested by business owners and long-term lenders. Question 20. The following ratios have been calculated for two businesses, both with the same revenue of $100,000. For X, the gross margin was 20% and profit margin 10%. Y, however, had a gross margin that was higher of 25% and then the same profit margin of 10%. This means we can then compare what their cost of sales and expenses would have been, and we are asked to compare them for both X and Y. So what we are going to do over here is, firstly, we'll look at the cost of sales. If you look at the gross margin, which includes the cost of sales, you can see that X's gross margin is lower than the gross margin of Y, and therefore the cost of sales of X must have been higher than that of Y. Expenses. would be the difference between your gross margin and your profit margin. And if you look at the difference over here compared to the difference over here, you can immediately see that the difference for X is lower than that of Y, and therefore X has lower expenses. So for X, the cost of sales is higher, but the expenses are lower. Look at the options given to you. You will see that B is a suitable answer, showing that cost of sales for X are higher and the expenses of X are lower, which is what you came to as your conclusion over here. The next question is number 21. A business provides the following information. Gross margin 20%, and then figures are given for sales, opening inventory, and closing inventory, and you are asked, what are the purchases? This question is very similar to the question that we did earlier in this video. Firstly, what we'll want to do is work out the cost of sales by simply taking our sales figure of 275,325 that is given over here and using our profit margin. Now, if the gross profit margin is 20%, that means that our cost of sales as a percentage of sales must be 80%. So if we take our sales times 80%, that will then give us our cost of sales, in this case, 220,260. We then recreate our formula of how we could have calculated that cost of sales using our inventory and purchases figures. In other words, we take the opening inventory, given here as 25450, plus purchases, which is a missing figure, and then subtract closing inventory, given here as 55975. And that would then give us the cost of sales figure, which we have just worked out. We can then solve for our purchases to determine that our our purchases figure must have been 250,785. If you look at the options available, you will see that C is the correct answer. At the paper from Cambridge, June 2016, paper 1-1. A company provides the following information. You are given figures for ordinary share capital and retained earnings at the end of the year, and remember that these two combined would be your equity. You are told about some 8% debentures. Remember, that's a non-current liability. Your bank overdraft, which is a current liability, and then profit from operations and profit for the year. Profit from operations would be before your interest expense, and profit for the year after interest expense. You are then asked, what is the return on capital employed? Remember that return on capital employed is looking at total capital employed, in other words, owned and borrowed, and therefore the return that we use needs to be the return for both the owners and the non-current liabilities. So what we'll do here is we'll use the profit before any finance costs. In other words, in this case, it is actually the same as profit from operations. However, it's usually safer to use your profit for the year and then add back your finance costs. In this case, 8% of 15,000, which is 1,200, but you will then see that you do actually get the same figure. The reason that I wouldn't automatically use profit from operations is that if there's interest income after profit from operations, you would actually take that into account as well. And then your profit from operations is not always the same as profit plus finance costs. But in this case, it is the same. It's always good just to check though. You then will divide that by your total non-current liabilities and your equity. In other words, you will use your share capital of 50,000 plus retained earnings of 11,000 plus your non-current liability, which is your debentures, of 15,000. Notice that I'm ignoring bank overdraft completely. It actually doesn't come into this calculation at all. Once I've worked all of that out, I will find that I have an answer of 23.29%. And if you look at the options available, that will tell you that C is the answer you want to choose. Question 22. A business purchases inventory by cash. Which effects will this have on the liquidity ratios? What you want to do is you consider the transaction of buying inventory for cash. In other words, your inventory is going to increase and your cash will decrease. And look at each of these ratios in turn. For the current ratio, remember that the current ratio is current assets to current liabilities, and keep in mind that both your inventory and cash are part of your current assets. Inventory increases but cash decreases, so in effect it actually cancels itself out and there is actually no effect on the current ratio. The asset test ratio, or the liquid ratio, however, is the current assets without inventory. In other words, excluding inventory or looking only at your receivables and your cash. And that is then compared to current liabilities. This means that the purchase of inventory will not come into play here at all, but the decrease in cash will. And so therefore, if you purchase inventory, actually your liquid ratio will decrease. So you are looking for an option where your current ratio has no effect or no change and your liquid ratio decreases, and that will then lead you to choosing C as your answer. Question 23. X supplies goods on credit. He looked at the financial statements of two other businesses to see if he wanted to trade with them. He found the following information. Now, remember that this information here is from the perspective of G and H. G had a total credit purchases of 21,800 and total payables of 2,320, which means that if you're going to calculate what G's payment period is, in other words, what X could expect as a collection period, you will compare these two figures by saying 2,320 divided by 2,180, or your payables divided by the purchases times 365, and you will come to an answer of 38,84 or 35 days. Given the fact that X only trades with businesses with trade payables turnover of 42 days or less, given the fact that 35 days is lower than the 42, it means that X will be happy to trade with G. If we do the same calculation for H, we take the payables of 5,750 and divide it by the purchases of 4,900 times 365, because there are 365 days in the year, and that gives us 42,4 or 43 days, which means that even though it's very close to the 42 days that have been specified as the limit, it is just over, and X will therefore not want to deal with H. So if we look at the options, we are going to choose B, where he will only sell to G. Moving on to Cambridge, June 2016, increase its return on capital employed in the short term. Which course of action will achieve this? Before you start looking at the answers, just quickly think about what ratio are we looking at. Return on capital employed refers to our profits, but particularly profit before finance costs, compared to the total capital employed. So if we want to increase this ratio, we either need to increase our operating profit or we need to decrease our equity and our long-term liabilities. So how would we achieve this? If we look at A, investing in new plant and machinery, all that is happening there is that the assets are being converted into other assets, and therefore there's no change in the return on capital employed because you're just taking money out of bank to buy tangible assets. Number B, if you make a bonus issue of shares, remember a bonus issue of shares means that money is taken out of retained earnings and then converted into share capital. So all you're doing is converting one form of equity into another. And again, there's no change in the return on capital employed. For number C, if you reduce your overhead expenses means that you are cutting your operating expenses or manufacturing overhead expenses, but the overall effect means that your profit before interest will actually increase. And if these profits increase, it means your return on capital employed increases. And so C is certainly an option that we can look at. Lastly, D, if you reduce the dividends paid to investors, remember that dividends are not actually an expense of the business and therefore do not affect the profits. And as such, there would actually be no change to the return on capital employed, and so D is not an option, and we would therefore choose C as the answer. Question 20. Which item is included in the current ratio but not the liquid or acid test ratio? This is such a nice, easy question, and by now you should be able to do this one with your eyes shut. Remember that the difference between these two ratios is just all your inventory. So immediately you will choose B as your answer, because the acid test ratio is the same as the current ratio, but inventory is excluded because it might not sell. The last question, 21, a business has prepared the following information for the year ended the 30th of April 2015. You are given your trading statement, basically. You've got your revenue or total sales, and then the calculation of cost of sales to get your gross profit. You are then asked, what was the inventory turnover? Remember that to calculate inventory turnover, you would use your average inventory if you are given beginning and ending figures. If not, you would just use whatever you are given. But if they've given you opening and closing stock as they have here, you want to ideally work out your average inventory divided by your cost of sales times 365, because there are 365 days in the year and we are looking for a full year. So what you will need to do is take your opening inventory of 25,000 and your closing inventory of 31,000 and work out the average. In other words, you add the two together and then divide it by 2 to get 28,000 as your average stock. You will then use this to divide by your cost of sales, in this case 114,000 times 365. This will then give you an answer of 89,65 rounded up to get 90 days. Look for this as an option, and there you can see it as